I've tested using UFO and AutoClimate by putting in $7,000. My return, it's a positive $5,000.
I could do my classical technical analysis to identify a trend, but when is the end going to happen? For a move to happen, what you need is not field orders. You need...
Everyone knows the market is very volatile, and one of the ways to make money in a volatile market is to be an active trader, right? Put yourself in a position, take long or short position, and make money out of it. But most of the time, the issue here is that it's very hard to know when is a good time to buy and when is a good time to sell. So I had a collaboration with Affin Hwang Investment Bank, and through that collaboration, I got to know this gentleman called Jose Blasco. So he's the founder of this company called Traditive, and he developed this tool to help traders to make better decisions when it comes to signals to buy and signals to sell. I got the chance to get my hands on those tools, and surprisingly, it works very well for me. So today I decided to invite him back to the show and to help me to better understand this tool and perhaps something for you guys to explore as well. And towards the end of the conversation, I will share some of my trades and some of my experience using it. And perhaps Jose can help me to pinpoint some of those mistakes that I've made so far. So Jose, welcome back to the show. Nice to see you again.
Thank you so much, Frankie. So nice to be back.
There are so many trading tools out there, from the classic ones like MACD, moving average, and stuff like that. And you developed this thing called the AutoClimate and also UFOs. Where did you get the inspiration that you want to create your own tool and not use those classic tools out there?
First of all, in my early beginnings, when learning how to trade, I quickly realized that in one hand, trading is all about risk management. And on the other hand, I realized that trading is like life. And therefore, it's all about timing, right? So the idea is, okay, so how can I approach my market analysis? How can I approach my, identification of opportunities in a way that my risk is under control and I am as precise as possible with the timing? So that was one clear thought in my mind when I got these initial aha moments, right? Where, you get into a trade, you get stopped out, and then the market goes your way, and you're like, well, I was right, but I was off timing, right? So this is one side of the equation when I started thinking about this. The other side of the equation is that my background before getting into trading is engineering. And therefore, I am a person who relies on facts instead of beliefs or feels or, nothing wrong with being an intuitive trader, which probably that intuition comes through experience. That's obviously a good one to have, but at the same time, you don't want that intuition to be subjective, for example, right? And because it's, we can define the word intuition in different manners. So, again, beliefs is a powerful thing. If you're a sport athlete, you believe in yourself, whatever. So for sure, beliefs is a strong thing, but at the same time, now you need to be exposed to the marketplace, and it's more a matter of being systematic, right? And how can you be systematic, being a human being where one day you have slept more, one day you have slept less, one day you feel more full of energy, one day less full of energy. And so the idea for me was, okay, let's move everything into the data arena and let's process data, right? This together with my background in technology. So it was an obvious thing for me to develop technology to be able to look at the markets, find opportunities where risk is under control, and the timing, we become as accurate as possible. Right. So that's the philosophy, the origin, the essence, if you wish.
But the classical tools like your moving average, MACD, RSI, those kind of tools also kind of use data to pinpoint the signals to buy or sell. So how are your tools different from the conventional ones?
Well, it's a very, very good question. And there are, in my answer, there will be some subtlety that makes the whole massive major difference. So, for example, if you look at MACD, RSI, CCI, stochastic, you name it, moving averages, Bollinger Bands, whichever classical tool coming from technical analysis, they are extremely smart tools. But there is one problem attached to the majority of such tools, which I'm not saying it's wrong to use them. Actually, some combination of tools may be the healthy sweet spot. But one of the issues in my mind, in the way on how I think about trading, is the fact that you have to come up with some sort of a parameter. Like the moving average, I use the 20, or I use the 50, or I use the 200. And next thing you know, with some parameter, that tool is very useful. And then you have a changing market condition type of scenario, like, a new president elected, a new pandemic, a new something happened with a supply, or the OPEC has something about oil. Next thing you know, you have a change of market condition, change of volatilities and so on. And next thing you know, those parameters stop working well. And by the way, the fact that you are using parameters such as, the average of 20 candles ago, the average of whatever, 500, 200 candles ago, the fact that you are looking back in time, it's also creating this lagging effect that is reporting to you what has been happening instead of what is likely going to happen next, which has not happened yet. Okay? Of course, no one can predict the future like a crystal ball with 100% accuracy. But again, if you rely on the past and the further to the left you go on a chart, the more of a lagging effect you're going to be accumulating. So then you rely on basically how lucky you're going to be that things stays the same. Right. So instead, with AutoClimate, AutoUFOs, what we're doing is that we are looking at the now. UFOs, maybe I should have mentioned it before. Maybe it would help clarify what I'm trying to say here, which may sound a bit abstract at this stage in our conversation because I'm being a bit generic at the moment. UFO stands for on-field orders. So if you think about classical technical analysis, which is, again, another school of thought out there, which is definitely very, very smart, but what technical analysis does is to study where orders have been filled. So you see the market go up and down, and you have these highs, you have these lows, support, resistance, patterns. This is basically where the candlesticks have been, which is where the orders have been filled in the market. The buy and the sell orders were executed already, and they're gone. So those orders that are gone have no power. They have power from the point of view of market memory, but they don't have power to produce a move that hasn't happened yet. Because for a move to happen, one move that has not happened yet, what you need is not field orders. You need on-field orders, UFO. So those on-field orders, when filled, they will generate a move that hasn't happened yet. So you work in the present, we don't know the future, but instead of working in the past with a lagging effect, you work on the present.
All right. So if I can summarize that, number one, you don't need to have too many parameters when you use UFO and also AutoClimate when it comes to trading and analyzing the chart. Number two, instead of backward looking, it is present looking, and it helps the traders to make a better decision to somewhat predict the future of what the price might be.
Correct.
All right. So I guess at this point, it is a little bit vague to the audience because we have been using words like AutoClimate, UFOs. You did a little bit of explanation, but let's go deep into it, right?
Yeah.
So first of all, what is actually AutoClimate?
So we are talking about two tools, and the reason AutoClimate and AutoUFOs, right? And the reason why I developed two tools is because the way I think of trading is a two-step process. So step one to me is to understand which side of the market should you be trading in.
Is it long or short?
Long or short. Yeah. Should you be a buyer or should you be a seller? That's the first thing, right? Because I would say probably the biggest mistake ever, which we have all been there when we are in learning stages, is that you have some particular assessment, outlook about whatever market, and you go long when it's time to go short, or you go short when it's time to go long, right? So, and again, it makes sense, but the idea is to try to avoid that, because this is the one thing that will jump at your face. Like typical situation, you buy a stock and immediately at the speed of the light, or Forex or futures or whichever market, you buy long, for example, and at the speed of the light, you get stopped out immediately. Whereas to get to your target is moving slowly and slowly, and it doesn't reach the target, but when it gets to your stop, speed of the light, stopped out on your face. What did just happen? You were on the wrong side of the market. You should be a buyer where you're a seller, or vice versa, right? So that's step one. Identify that. And the tool I developed for that is AutoClimate, right? I think the word climate kind of intuitively says it, but I'll explain that better in a moment. Then, once you know if it's time to be a buyer or be a seller, then the second question that probably is the most important of all, what is my entry price and what is my exit price? That's when the precision kicks in. Okay, and of course, we cannot do impeccably precise every trade of our life because the future is still the future and it's impossible to predict with total certainty. But with tools that focus on on-field orders, instead of price memory from the past, which may or may not act, we are focusing on where the on-field orders are. We have higher odds in our favor to catch a precise entry, either to go long or to go short after we have determined if it's time to go long or short. So step one, time to be a buyer, time to be a seller, yes or no? Step two, what price do you get in at, what price do you get out at. And that's AutoUFOs. So basically 2 tools. So you do step 1 and you do step 2.
If you look at the screen now, this is how the AutoClimate looks like. It has a series of small dots, big dots, blue dots, and red dots. Could you explain to us what do they mean?
Basically, the color, I would say, in a way, is kind of self-explanatory. A blue dot represents an up climate, meaning a market condition where a trader has a statistical advantage by going long. So going short would be forbidden, if you wish. If you are very conservative, you would be like, no way I'm going to go short. It's a blue climate. I'm going long only, right? The red dot is the opposite. The red dot is a down climate, and therefore it's time to be shorting. Now, those dots could also be thin or thick. So sometimes the blue dot is a tiny one. Sometimes the blue dot is a thicker one, right? Or same with the red dot. When the dot is thin, it means that the market data does not reveal a statistical advantage in any direction. It's what we call an unconfirmed climate.
Right.
You still have a color, blue or red, which tells you there is some sort of a directional kind of like bias, but market data is not clearly showing a statistical advantage. Okay, to clarify what I mean by a statistical advantage, again, this is coming from a lot of data processing, but if we think about in terms of classical technical analysis, typically a healthy market condition, a trending market, typically would be made of impulses followed by corrections and another impulse and followed by a correction. So you have a specific price action that basically suggests continuation. Where other times you have a few candles going up there, but it's all so shy, it doesn't represent institutional buying, it doesn't represent large market players in the market likely going to push the price further, and maybe that just could be a market condition where it's not defined, and therefore trading is a gamble. So when that's the case, the dots are going to be thin. So if you want to trade, you have some bias, up or down, blue or red, but you don't have odds in your favor. So particularly my application at that time would be, I don't trade.
Right.
Okay.
Well, sometimes those dots comes with long tails and short tails. And what do they mean in this case?
The long tails and the short tails in the AutoClimate, not on the candles, but on the AutoClimate in the bottom part of the screen, those long tails represent the market volatility condition. When you have a very, very long tail, it means that the market is stretching itself very, very much, which in one hand is good. But when you see the long tail already, basically it means that the peak of volatility has already been reached. So probably you're reaching a time where the party is about to be over, right? So what you want to do is that you want to identify climates which are confirmed with those thick dots, blue or red, long or short. And then you want to see tinier tails. So you enter in a market condition which is safer, expecting volatility to kick in after you got in.
Right.
That's the idea.
Right. Interesting. Now, there's still one more element in the AutoClimate table, whereby you have this row of some statistics numbers over there. It has standard deviation, it has like numbers of candles and whatnot. So it's a little bit confusing for new beginners. Perhaps you want to share with us what are those numbers mean? For
sure. It's very important. I mean, if I was to refer to a classical quote from Wall Street, I would say, the trend is your friend, right? Everybody has heard that. It's written probably in every single trading book ever written, right? But the real statement, if you were to complete the statement, would be more like the trend is your friend until the bend at the end. That would be the real statement, right? And the implication for traders is, okay, fine. I could do my classical technical analysis to identify a trend. Maybe I use trend lines, I use moving averages, I use, RSI between 40 to 60, whatever, right? And now you have an understanding that the market is going up or going down in a trending fashion. Fine. But when is the end going to happen? That's the key. Because if you were to enter a market too high in an uptrend or too low in a downtrend, you may still get a little bit of profitability going your way, but your reward to risk ratio may be very poor. Whereas if you enter the market when the trend is in a healthy beginning, ready to fully develop, but that has not happened yet, then your targets are going to be so far out, which means that now when you get to your targets, you just made, 3, 5, 10 to 1, whatever that is, depending on the market conditions and the volatility of the moment. But the idea is to maximize those reward to risk ratios. That's what those numbers are for. Because as I said at the beginning of our conversation here, so it's all about risk management. You want to time the markets, you want to be precise, you want to do whatever you can to be, as precise as possible, knowing that the challenge is the future. But the one thing you have full control over is not the future, is your risk management. That you have full control over it. So by entering a climate in an early healthy stage, you would benefit, if right, of the whole development of this climate, which would improve your reward to risk ratios, which work extremely powerfully towards your goal of managing risk, right? If you were to enter the trend when it's about to end, you may have a 1-to-1, thank you very much. But if you keep getting 1-to-1s and then you get 3 losses in a row, it's painful. Whereas if you get 3-to-1s, 5-to-1s, 2-to-1s, 10-to-1s, and now you get 5 losses in a row, you don't feel it. So this is the difference. So long explanation, but this subtle understanding, I believe, makes a difference. So now going back to your question with the numbers, so we are trying to understand when the bend is going to happen, when the trend is going to end, right? And therefore, we are talking about sustainability. Is the trend sustainable or not any longer? How do we measure sustainability? We measure it from 2 angles. Angle number 1 is the count. Another way to think of count is duration.
When you say count, is the count of the candles?
Count of the candles.
Right.
How many candles are in whichever time frame the climate is applied to. Counting candles is another way to say counting time. So the count equals duration. And that's one of the measurements. There are 2 measurements for sustainability. Duration is one of them because each market is made of specific market participants. Like, for example, if we're trading crude palm oil futures in Bursa Malaysia, the type of participants that trade the markets are going to be totally different compared to NASDAQ futures in the US or gold futures in Taiwan, which they also trade gold futures in the Taiwan exchange, right? So the market participants are going to be different, and therefore the way they buy and sell, the strategies they use, the sizes that they use is going to be different. So that basically creates some sort of what I like to call the market nature. Actually, I normally use the term the nature of the beast, or just for my own thinking, right?
I call it the DNA of the market.
Here we go. I love it. Each market has its own characteristics, and therefore when you see a wave going up or going down, a wave that is impulsive or a wave which is correcting, all of those waves tend to have a specific duration because, that has to do with the trading activities injected by the large market participants, where they get in, and when wrong, they hedge, or they get out, and when they get in and they're right, then they take profits. And so there is some sort of a pattern from a duration point of view.
Right.
The other type of pattern, which is related to sustainability, is what we call the max distance. Okay? How much a market tends to stretch, so now it becomes non-sustainable. And that totally depends on the market. The definition of max distance, or what I like to call too far, too fast. What is it that this market went too far, too fast, and therefore not sustainable? So bond going too far, too fast may mean something different compared to crude oil went too far, too fast. Because the nature, the DNA of those markets are different, right? So what we're doing with AutoClimate is that we are looking at those dots, blue and red, right? Confirm or unconfirm, up or down. And then we're like, okay, so the market is in this condition. Is it sustainable or not? And that's when the statistics come into play, where we compare the current status versus what a statistical behavior which is sustainable is.
Right.
That's what we do.
Okay.
So we compare 2 figures against the reference figures, right? So maybe for market ABC, too far, too fast is 5. So if the climate shows you we are currently in the stage of 4, well, then it's not moving too far, too fast. So that climate is sustainable. Whereas if too far, too fast is 5 and the indication is already telling you are moving at a speed of 7, well, that is statistically unsustainable. It doesn't mean it's going to turn immediately. We've seen crazy things happen in the market, but that's another saying in Wall Street. The market could remain erratic longer than you could remain solvent, right? So we have to respect what is happening on the charts, but at the same time, it's a very good reference to know that it went too far, too fast, or it didn't.
When I was using the AutoClimate, is that sometimes when there's a change in fundamental of the markets, that's when the prices can move volatilely, like up or down, right? And this is where sometimes the AutoClimate statistics doesn't really work, right? Because it is trying to recalibrate and find a new sustainable number
Correct.
for for those candles.
Correct.
Right.
When something new and impactful kicks in, I'm going to go for an extreme. We are far from that, luckily, but March 2020 with the pandemic, right? So when something like that kicks in, forget about statistics. Nothing is relevant.
Right.
I mean, it's still not a bad thing to have a reference, which is based on facts. It's better than, okay, the market is going nuts, let's gamble on a trade. That would not be professional, right? So it's still good at that stage to have a statistical reference where you could be like, okay, this is crazy. And I mean it's crazy because it's beyond too far too fast and it's beyond the count. So then you objectively say it's crazy. Now, crazy doesn't mean it's not to be respected because the markets sometimes are crazy and it's real. So, so again, the statistics are not a guarantee in this case. Okay, we are not looking at, like the performance of a portfolio from a hedge fund, for example. It's not what we're doing here with those measurements. We're just looking at defining a reference, whereas beyond that, you are late to the party and it's better to find another trade somewhere else. And before that, it makes sense to expose yourself to the market because if you catch the move, you are in a position where you may catch the whole development of the climate, which really betters your reward to risk ratios.
Right. So in terms of risk management, then can I say that I wait for the climate to settle down and wait for the statistics to recalibrate and then I start trading again?
Correct.
Would that be a better way of using it, or can I just ride on the trend and
in the end, now we are talking about trading personality, right? And because the future cannot be predicted with guarantee and for sure, so then in the end, you will hear me talk in our conversations all the time about the pros and the cons, right? So if you were to act very quickly, it's not crazy. But what's going to happen is that you will get less winners compared to a trader who is more conservative and may wait for, instead of one dot on the AutoClimate, maybe wait for 2 dots.
Right.
So you have more of a confirmation that the climate is established. Not only the climate is detected, but it's actually established. So you would have more winners like that, but you would also have less trades. So in the end, who makes more money? To be honest, to me, it doesn't matter. It's more about, when it comes to trading, it's a matter of confidence, and therefore you have to be comfortable, and therefore whatever you do has to be in line with your personality. So there is a human psychological element. So I guess that, like any tool, the use of it could be, there is a little bit of tolerance to use it like that or like that. Just like when you drive a car, some people drive 80, some people do 120, and I guess it's both fine, right?
Understand. Okay, so just now we spoke about parameters. Is there anything that I need to do when I use the AutoClimate? Do I need to set like certain numbers for it to work to my favor?
My recommendation, no matter what we trade, no matter which tools do we use, my recommendation is always to run a process of backtest, which means you input the tool that you're going to use and you go back in time. And there are platforms that allow to do this very easily, like TradingView, for example. You have market replay functionality. So you can really put yourself back in time using the tool and see how you feel with certain parameters. My initial answer to your question would be, don't touch it, leave it the way it is. It's because in the end, it's gonna give you statistics based on your parameters. So there is no need to do anything with it.
Right.
Okay. But at the same time, as I just said a moment ago, I recommend everybody to do a backtest. Okay. And when you do the backtest, you may realize that, hey, you know what? I like to be a bit more on the conservative side. I like to be more on the active side. And so, of course, you could change some of the parameters to make the indicator to be just a little bit more dynamic or less, depending on your liking. But again, I would say no need to overthink, right? Because the danger of backtesting as well, which I recommend it to everyone, just so you get to know you as a trader. But the danger of backtesting for too much and for too long is that then you end up overfitting the parameters of the tool to a specific time in the market when there was a specific condition that was very trending or very non-trending or whatever. So again, it's better to let AI do its job and not to, if I may use the word mess, can I use the word mess? not to mess too much with it, if I can, and let it do its job. That would be kind of like probably the pragmatic approach.
That's the best way to put it. Let it run by itself. AI will do its job and give you the best indicators on the market. So now let's move to UFOs, right? First glance, it may look a little bit confusing. It's colors everywhere. Red UFOs, green UFOs, big and small, stretch and small and whatnot, right? So could you, first of all, explain to us why some of the UFOs are stretched so big and some of them are so small?
Well, it has 100% to do with the market volatility. Those UFOs, again, they represent on-field orders, right? So orders that have not been filled yet. orders that are in waiting stage. They're in waiting state. They are waiting to be filled. And of course, for those orders to produce an impact in the marketplace once they get filled, it needs to be a large quantity of them. It cannot be like a small pile of orders like this. That's going to do nothing to the market. It's going to be absorbed, and you will have a little fluctuation on the candle, and that's it. You want to catch a move, right? So what the technology is doing is focusing on where the big piles of orders are. So in other words, the point I'm making is big, right? And because it's big, and you think about market volatility, so put yourself in the shoes of, let's say, an investment bank just capture a new client, a family office, multimillionaire, whatever that is, and comes in with this very significant amount of capital to invest and build a portfolio. And that investment bank is putting all that money in the market now, willing to acquire shares or futures contracts or commodities or bonds or whatever market is being traded, right? When all that capital is coming in, and let's say it's to buy, the same would happen if it's to sell, but let's say it's to buy, for those orders to be filled, you need the same amount of selling at this price than the buying coming in.
Right.
So the orders get filled. If you have more buying than selling, then whatever selling it was available would be filled. And the moment no sellers are left,
the price is going to go up.
Prices are going to go up, leaving unfilled orders behind. That's the key, right? Those are the ones we want to identify, right? So if price comes back to this price, then they will be filled and generate a bounce, right? So this is what we are looking for. And again, when that particular investment bank is trying to get all those orders filled for that client XYZ, it could be a day where market volatility was very quiet. It could be a day where it was a pretty volatile day, pretty active, and kind of like one of those crazy days. And therefore, the algorithmic trading system from those investment banks, which try to get as many shares or contracts filled as possible, they may need to chase price a little up, a little down. And therefore, when you then see the whole zone in the chart, the whole band, right, where buy on field orders have been detected, then it becomes a wide zone. And it's because all this trading activity that was identified happened to be in a volatile day. Whereas when you have smaller UFOs, the ones that are narrower, like vertically speaking, they are shorter, right? So that basically tells you that market volatility is limited, right? And therefore the orders are closer to each other.
Right. And what are the differences between the outer ring and the bold dot in the middle?
Very good. So this is kind of like the shape of the flying saucer, right? So what's the difference between the inner circle and the outer circle? The difference is that the whole circle, starting from the outside one, it's where you have buy or sell orders, depending if it's red or green. Red for sell, green for buy. But the inner circle, the one that is darker inside, and is the inner one. So that one represents where the greatest concentration of orders is identified. That's where the greatest concentration of orders. And why do we do this? Well, because if you think about taking a trade utilizing AutoUFOs, a classical application would be that, let's say you have a band, and let's pretend it's a buy. So this is a green UFO band. So when price comes here, you would want to buy anywhere inside the band, and you would want to put a stop or some contingency measure, hedging technique, whatever, on the other side of the UFO. Because if all of these represents buy orders and price goes through, well, that proves you, like
wrong.
Factually, proves you that where you thought there were buy orders, there are none. So you are wrong. So you better get out, because then staying would mean hope, right? So in other words, a typical technique would be to enter somewhere on the top part of the UFO with a stop or protection on the bottom part. But of course, now you are taking all this risk. Which, as you said, sometimes is narrow, piece of cake, easy, convenient, but sometimes the UFOs are wide because of market volatility. So then what you could do is rely on the inner circle, where you have more concentration of orders. Instead of buying here with a stop here, you may focus on the inner circle and you buy here with a stop here, which reduces the risk from this to this.
Right.
Now, of course, like everything in life, pros and cons.
Right. I immediately know what's the con. Is that because you want to wait for the middle, and the price comes down here, touch the tops, but it rebounds back up.
And you missed it.
Yeah, and you missed it.
That's the price to pay. But at the same time, that's how you manage risk if the market is too volatile. So that's professional behavior. This is job well done,
Right.
So again, as I said, the tools do what they do, but of course there are subtle variations on how one could utilize the tools. Earlier we talked about climate being more conservative, less conservative. Here we can be more Can I use the word stingy?
Yeah,
You can be a bit more stingy, a little less stingy, or more generous with your risk, right? So you go for the whole UFO, maybe you go for the inner circle only, right? Of course, being a bit stingy pays you well, right? But you may miss the trade, which is the price.
Next, I would like to discuss about the band, the UFO band. So when you look at the chart, some band starts from very close to the end of the timeline, but some band starts from very far away from the timeline. Do they have significance in terms of the distance that they go back in time?
Basically, the plotting, what it does is move to the left until it hits candles on the left.
Okay.
Right? So if those candles on the left at this price level were found 5 years ago, then that UFO band will go all the way to the left until 5 years ago. If the candles on the left at this price level are found, five candles ago, then you would have a tiny band hitting the candles immediately because the candles are right there.
If the band stretched all the way back to 5 years ago, is that UFO still valid? Because you're talking about 5 years ago, the orders were there.
Yep.
And today, the orders may not be there anymore.
That's a fantastic, fantastic question. And of course, the answer is it depends.
Okay.
And let me explain that better. Let's say, for example, I'm going to go back in time for a long, long, long time, okay? Just to have a very, very, very powerful example everybody remembers. So 2008. Global financial crisis, the markets are crashing like crazy, S&P 500 down 50+%. The world is ending, everybody's scared. And next thing you know, price gets into a UFO and bounces back up and never came back, right? So that UFO that was so powerful in 2008 was created somewhere in the 90s. And
really?
Yeah.
Wow.
And you may be thinking, wait a moment, in the 90s, the markets became electronic in 1995. The markets were not even electronic then. How come those on-field orders are relevant? Well, think about it. If there is some financial institution, okay, and again, each case is different, and that's why it depends, and sometimes you'll be wrong and you'll be stopped out, okay? But if a financial institution took a trade sometime in the 90s, and they were able to ride the whole tech bubble during the 2002 plus, after the tech bubble, all the way to 2008. So they made a lot of money buying at that UFO level from the 90s many years ago. If you now add inflation to that price, and someone tells you you're able to buy the S&P at the same price you would have bought it in the 90s, and it's 2008, but if you add inflation, it's like if you are buying the S&P at the price of, I'm just making this up, in 1970, right? Would you buy or wouldn't you buy, right? If you're a value investor, like many funds are, right? So, of course, you could even argue that maybe now more on-field orders are added on top of whatever on-field orders were waiting to be filled. So it's not like the orders are waiting since 1990 to get filled in 2008 or orders from 5 years ago until now. The orders, for sure, when you place an order in the market, it ties up capital. So what those intelligent trading systems do is that, if the market moves too far, so those orders are canceled, and those monies that were used for those orders are being used to trade other markets. But, I guess it's pretty much common sense if I ask you this question, don't you think they would have alert systems so when the market is coming back close to where, they had orders that they were very satisfied with and they would want to buy more of that at the same price, don't you think they would now go ahead and replace the orders and potentially add more?
Right.
And the answer is yes. So all of this is very dynamic. And the technology, by the way, is analyzing the markets dynamically. And sometimes you will see bands that go very far back to the left, and sometimes they won't. So it's a matter of analyzing market data.
Right. Okay. So one thing I noticed is that when you play with the settings of the UFO, you can actually tick that UFO stats option. And what it does is that it will show you the statistics, a blue color figure on your top right of the chart.
Correct.
What does that percentage mean?
That percentage is a percentage that is there for calibration purposes. So let me explain calibration and let me explain exactly the meaning of that figure, because that's a very good point. Many users at first, maybe they didn't look at the user guide or maybe they jumped into the tool immediately and they see the figure, and an interpretation of the figure could be return on investment or performance, okay? And that's not what the figure means, because...
When I first saw it, I thought it was the accuracy of the UFO.
Yes.
Oh, yes?
It is what it is, but of course, accuracy could be a different thing depending on how you measure it.
Oh, okay.
What is accuracy? Hitting 3 to 1s? What is accuracy? Hitting 1 to 1s? So again, we need to dive a bit deeper into this so it's well understood, okay? But again, the question is extremely, extremely relevant. So first of all, as I said earlier, we can make the tools more conservative or aggressive, which has nothing to do with the technology. It's about accommodating the tool to the individual. Because no matter if we use AI or not, in the end, the person who owns the money that is traded in the account is still a human being and therefore emotional. So trading emotions needs to be under control, and therefore the tools we use, whichever tools they are, including UFOs, have to be calibrated to the liking of the user, which I will make the same comments before. If you don't touch it, it's not a bad starting point, but there is nothing wrong with doing some calibration and adjustments as well to adapt it to the trader, right? So now, how can you calibrate the tool if you cannot measure what the tool does? You cannot.
Yeah.
So that's where the number comes in. Those UFO stats tell you the performance of the tool as you change the calibration. So you can conclude, okay, my number is this, right? For example, my calibration setting, I believe you know this, is the golden ratio, 0.618. And that's what I use for calibration, okay? By default, it comes as 0.5. Calibration goes from 0 to 1. By default, it comes with 0.5. So it's midpoint. It should make everybody happy, the conservative and the aggressive traders. But you can, tweak it a bit.
All right. So when it goes to 1, it's more aggressive, I suppose?
More conservative.
More conservative.
And when it goes towards 0, more aggressive.
More aggressive. Okay.
So what happens to that figure when you change it, and what does that figure means? Right? So if you look at the chart, right, and you plot your UFOs, you have the green below and the red above. So what that figure tells you is what happens statistically across the market data you have loaded, which this, by the way, depends on the market you load. Like, for example, if you load Bitcoin on a monthly chart, you have very few candles. If you load IBM shares in the US market, you have so many candles. It's a very old stock, right? So depending on the market that you load, you have more or less data. So whatever data you got, that figure is going to tell you how often, for the whole duration, how often every time price came to the green, it bounced enough to reach the red. And each time it got to the red, it bounced on the opposite direction going down until it reached the green. How often that happened? No matter, because the UFOs sometimes are far apart, sometimes they are very near, right? Sometimes it's a market condition with no volatility. So if you take trades, it's 1-to-1. Sometimes the market condition is very volatile and the UFOs are further apart. So no matter if they are further apart or nearer to each other, how often do you bounce from green to red, or how often do you bounce from red to green? And of course, let's say you got a performance of, let's say, 60%. It means that 60% of the times you reach what we call the rival UFO, right? So you enter at this UFO, is green. What's the rival one? The red one. Because when it gets to the rival, it's going to reverse. So that's where you want to take profits. If you short at the red, what's the rival UFO? The green. Because when the market is going down, you better buy to cover, because if not, it's going to bounce back against you, right? So if you got a performance stat of 60%, it means that statistically, 60% of the times, you reach your rival UFO, which is a great reference. Now, does it mean that you make 60% per year? Doesn't mean you make 60% per day. No, it doesn't mean any of that. It just means how often you bounce and reach the rival UFO. Depending on how far the UFOs are, maybe you have a rule in your trading plan that says, I only take trades with a minimum 2-to-1. I only have trades with a minimum 5-to-1, depending on the rules of your plan. Depending on your sizing rules. Every time I trade, I raise 1% of my account. Every time I trade, I raise 2% of my account. Every time I trade, I raise 5% of my account. Depending on all those rules, then that 60% may translate on 200% a year, or 10% a year, or whatever. That will depend on the use case. Last one. When you change the calibration figure, the UFO performance stat will change. So when you go to lower values, closer to 0, like 0.3, 0.2, then you will have worse performance. The bounces will be less accurate.
Oh, why is it so?
Because you are finding pile of orders in the market which are less significant. Remember when we said that we look for very large piles of buy and sell on-field orders? How can I make myself more aggressive, more active? Well, trade smaller pile of orders. And if I get smaller piles of orders, then I will find more areas on the chart where I could potentially buy and sell, but the accuracy will be penalized. So I trade more often, but I get stopped out more often too, right? Now, what if you move the value above 0.5 towards 1, like 0.618, 0.7, 0.8, then you will have very few trades, but they will be more accurate. Maybe instead of 60%, now you can see 72% on your performance UFO. Again, it depends. And On top of everything I just said, but I know it's a lot, it will also obviously depend very, very closely on the market you trade. Because we are looking for on-field orders. If you were looking for on-field orders in, let's say you got a penny stock with very low volume, well, the amount of on-field orders is going to be very little, precisely because it's a penny stock. If that stock was traded very heavily by institutions and many, many orders came in, it would not be penny. It would go up in value. The fact that it's penny probably means few on-field orders. So you would expect on a market of this sort to have limited performance, still a statistical advantage, but limited performance versus you apply it to FCPO, you apply it to S&P futures, you apply it to crude oil futures, things of that sort, right, where it's more liquid. Therefore, you got more orders. Therefore,
Understand.
Yeah.
You have used the word golden ratio quite a couple of times. I'm also convinced to use the golden ratio, which is 0.618. Maybe for those who are not so familiar, you could share with us, what does this golden ratio mean? What is 618?
It's just, Alex, I explained where is it coming from. But I have to say that the reason why I use it is not because my stats get to more or less where I want them to be, and just because I love FIM numbers, because then I don't have to think. Okay, so it makes my life easier. But let me explain where this is coming from. So there is centuries ago, there is an Italian mathematician called Fibonacci. That was his last name. I forgot his name actually. But his last name was Fibonacci. And he did an observation, which is if you take number 0, and then you take the following number, which is 1, and then you add them together, 0 and 1 is 1. So now you have a sequence which is 0, 1, 1. And then you take the two prior numbers together, which is 1 and 1, right? And you add them together, and now 1 and 1 is 2. So now the sequence is 0, 1, 1, 2. And then you do repeat. You take the 2 and the 1, 2 plus 1 is 3. So now you have 0, 1, 1, 2, 3. And then 3 and 2 is 5. So you have 0, 1, 1, 2, 3, 5, 8, 13, 21, 55, 89, etc. Right? And that's the Fibonacci sequence. And the golden ratio comes when you take two numbers from anywhere in the sequence and you divide them by each other. So you take 89 divided by 55, or 5 divided by 3, or whatever divided by whatever in the middle of the sequence. As long as there are two numbers next to each other, you take one divided by the other one, and magic, you got 0.618, right? Yeah. And it's like, okay, so it's like a ratio you find in nature, you find in places. And look, when, everything I do, including at a personal level, if I need to pick a number between 0.5 and 1, and I want just a bit more than 0.5, 0.618, that's it. I don't need to think. And if there is any benefit about this golden ratio, because it has to do with nature, which I don't know if that has an impact in the marketplace, because I didn't measure it. Talking about facts and data science, I didn't do that exercise. Well, if that has an impact, well, thank you very much, because I have the impact in my hands. But most importantly, my UFO performance metrics are what I want, given my risk profile, given my risk appetite.
Maybe just one last question before I share my experience, and then you can comment on my trading style, right? Trading strategy. The question would be, my assumption is that the UFO stats will not change no matter what time frame I'm looking at it. But when I was playing with the charts, I noticed when I changed the time frame, the statistics changed as well. Why is that so? Because ultimately, the number of unfilled orders is the same.
Yeah.
But why, when I change the time, everything runs?
It's actually a very simple fact. A very, very simple fact is, let's call it physics. Think about you are applying AutoUFOs. I'm going to go extreme, okay? Let's say you apply to a monthly time frame. So you have a UFO here to buy, green UFO. You have a UFO here to sell, red UFO. Now, from here to here, the distance is humongous. You need to travel many points, many handles, many ringgit, many dollar, whatever market you trade. You need to travel for a long time to get to the rival UFO. But now let's do the same thing on a 5-minute time frame. Okay, you have the green UFO, you have the red UFO. On the chart, they look just as far. But if you look at the price scale, maybe you only need to travel a few cents. So what's the probability that you get into a monthly trade? And again, I'm going for an extreme, so this is well understood, right? So what's the probability you get into a monthly trade? And you may need 6 months to get to your target. This is a long-term trade, or maybe a year to get to your target. And everything is under control. Statistics are in your favor. The trade has been planned accordingly. Everything is fine. But what's the probability that during months of time, something happened and a new war starts or a new war stops, or, maybe not the most pleasant thought, but you know what I mean. Things happen, and next thing you know, new orders are added to the market that were not supposed to be there. And next thing you know, they create a turning point, right? And now you never got to your final target, and therefore your statistic is worse, right? Versus in a 5-minute time frame, where to get to your target, maybe it only takes 40 minutes, 20 minutes, 5 minutes. And what's the probability of something dramatic to change the markets in 5, 20, 40 minutes? So that's why typically, which is counterintuitive, right? Because the school of technical analysis would suggest that everything on a larger time frame is more reliable. Well, when you look at market microstructure, when you go to the lower time frames, actually you get more efficiency on your actions, right? So that's why you get more performance on the lower time frames than the higher time frames.
So it is from Jose that I learned all these things, and I've started experimenting using UFO and also climate on my trading. I started this experiment from the new year, 1st of January. Today, at the time of recording, we are on the 22nd of January, so it's a good 3 weeks now. Let me just share the big numbers first. I've tested using UFO and AutoClimate by putting in $7,000 US, and in a span of 22 days, I've made exactly 105 trades. If you average it out, about 5 trades a day, which is quite a lot. And my return, it's a positive 5,000 US dollar. Now, you may think that I'm a very aggressive trader now because in such a short span of time, I'm able to make so much money, right? So this is how I use your tools. Number one, I didn't really understand AutoClimate. So yes, I can see blue and red, but all it does for me until yesterday, before we have this conversation, is to give me the comfort that it is in a bull market or a bear market. But I didn't know how strong or how weak is the market. So that's all. That's how I use AutoClimate. So my main focus is on the UFO, and when I enter a trade, no matter it is a long trade or a short trade, I limit myself to not go in more than 10% of my capital, right? And before I even do that, I will look at the time frame because I notice there is different statistics on different time frame. And my understanding on the statistic is the accuracy of those UFO, when it will bounce and things like that. So I will look through different time frame to look for the highest percentage, the highest accuracy, and I trade in that time frame. So let's say the price hits the top of the UFO, I'll enter no more than 10% of my capital. Sometimes it overshot. Now, I have to admit I'm very bad at risk management, at stop loss, because my confidence is that there are many more UFOs down there. So no more than 10%. If it bounces, great, fantastic. I will ride it, and then when it hits the rival UFO, I will take my profit. But if it goes down further from the UFO, what I do is I'll take another 10% and park at the second UFO.
At the next UFO.
Yeah, at the next UFO. And sometimes it goes down a few UFO. And sometimes I end up putting it 60-70% of my capital at the end and hope that it will bounce. Probably that's one of the reasons why I'm able to make $5,000 with 7,000 capital in just 3 weeks, is because of that one or two very drastic trades. But usually the trading performance is more like scalping. So what I wanted to catch was that bounce. And once I make a decent amount of gain, then I'll just close the trade. Probably not the best way to trade, I understand, but I still cannot find that sweet spot of where should I take profit and where should I do the cut loss. Maybe you can share your opinion on my trading style.
Yeah, for sure. Well, first of all, congrats for, just like the effort of, making sure you had those 5 trades a day and so on for this duration of time. That's fantastic. Okay. And of course, trading styles is trading styles. Okay. So indeed, what you explained here sounds a bit on the aggressive side, but I also am very comfortable listening to what you said, because it's not like you're hoping, like the market went against you and now you're hoping I'm going to buy more and dollar cost average and see what happens. You're not doing that. You are pre-planning. So there is a technique called scaling in, right? So you are ready to scale in more capital at further UFOs. And you have those UFOs identified before you begin with the trade at first. So those orders are ready to jump in if needed to ultimately, capitalize on the trade. So this is called planning. And therefore, while it's very active and, borderline with aggressive based on your definition, totally in peace with that. It's not.
Right.
I don't see that's a problem.
Cool.
Okay. Now, going back to your question about when to get out, something that could be very useful is going back to the climate. So you got into a trade, and now it's working in your manner. Is working in your favor. So a very healthy action would be look at the climate statistics.
Right.
And don't get out until you get to values that suggest lack of sustainability.
Right.
And now you get out. So now you are trying to maximize the move. But basically, what tends to happen in an up climate is that buy on-field orders tend to be added while sell on-field orders tend to be canceled. Right? And vice versa in a down market. So I'll repeat it for down markets. In a down market, sell on-field orders tend to be added, whereby on-field orders tend to be canceled.
Yep.
So if you were to observe the chart, the market is going up and you see, oh, new green UFO, oh, new green UFO. Market is going down, you say, oh, new red UFO, right? In other words, while it makes a lot of sense to buy at the green and sell at the red, if the climate is clearly up, maybe it doesn't make sense to take profits at the red. And you want to ride it further because in an up climate, sell on-field orders tend to be canceled.
Right.
So you may want to drag your stopping point following price below new green UFOs that are formed and let the move continue, ignoring the red UFOs because you're in an up climate, right? Until statistics tell you that the party is about to be over.
Right.
This is a powerful technique on how to maximize the profits. It may require a bit more of manual monitoring. But again, assuming it's in line of the trader style, it's worth it.
So perhaps my mistake is I didn't understand AutoClimate well enough to maximize my profit. So maybe that's the thing that I'll try. And probably two, 3 weeks later, I'll check in with you again to share my experience.
Well, this is like everything, okay? Let's say you were to learn tennis, right? And it's the first time in your life, and now they are teaching you how to hold the racket. And your natural tendency would be to hold the racket from the middle, where now your coach is telling you hold the racket from the extreme. And now you are uncomfortable with the hand, okay? But now you kind of play for a while, and now you are accustomed to this, right? So now you have the coach come in, and now he's teaching you technique, right? How to lift, how to cut the ball, So this is kind of like, in a way, again, love analogy is not sure if it's the best one. This is kind of what you've done. You've been practicing with AutoClimate to a point where you're comfy. You know what you're doing. But now maybe you can squeeze a little bit more performance here and there.
Right.
For example, doing what I just suggested.
Cool. Perhaps we can organize a workshop session, and then we can open up to more audience to come and join us, and then we can learn about AutoClimate and also AutoUFO together in the future. Looking forward to that.
That would be really fun, isn't it?
Right. Cool. All right. Thank you so much, Jose.
Thank you, Frankie.
Yeah. Thanks for coming by.
Super pleasure.
All right.
Thank you.
Thank you.